Welcome back to Initial Markets. Today I want to talk about a topic that's often overlooked by casual investors, and that's how options activity can actually influence the price of the underlying stock or ETF. We'll focus on SPY, the ETF that tracks the S&P 500 because it's one of the most heavily traded instruments in the world, both in stocks and options. Most people think options are just contracts that let you bet on a stock going up or down, but in reality, options can move the very market that is tied to, especially when large institutional players are involved. Calls are giving the buyer the right to buy SPY at a certain price, and puts are giving the right to sell at a certain price. The key is that for every options contract, there's usually a market maker on the other side, like a big hedge fund or bank that has to hedge their risk. If a market maker sells a call, they might buy shares of SPY to hedge. If they sell a put, they might sell SPY to hedge in the opposite direction. So even though they're just option contracts, the hedging activity behind them can cause millions of dollars of actual stock trading every single day. And if you look at the chart, this is where things get very interesting. Let's say SPY is trading around $680, and there's a huge concentration of $690 calls set to expire this week. This would be a call wall, a specific level in the market, which just is a strike price with extremely high open interest. Market makers who sold these calls must buy shares of SPY as it approaches $690 to hedge their position. This can create buying pressure, almost like a magnet pulling the price toward that strike price. But here's the big twist. A call wall can also be very bearish. When SPY gets close to $690, market makers hedging can start to reverse their position. Since they already bought shares to hedge their calls, they may sell into strength or stop buying aggressively, creating a ceiling. And the result of that is SPY not being able to succumb to 690 call wall, starting to pull back, making it act as a resistance point. They can climb up only to stall or reverse, as you're seeing on this current chart. And the same thing on the flip side. And you may be asking, how can you determine if it's actually a wall or just typical open interest? And it's very easy to check out if you look into your brokerage or if you do some research online. Right here I have an open interest calculator that I have pulled up, and you can see the 690 call for expiry the following day is extremely high. So this would be easily classified as a put wall between 688 to 690, and that's exactly how I was trading today. You can see the open interest for puts is far lower, so you are not going to be classifying 680 as a put wall. There is just not enough open interest. So when you look here on a scatter view, you can see the only major outlier is this 690 call, and that is going to be acting as a big resistance level. And that you can totally see that just looking at the chart. We have surpassed 690, just a fallback below, and again, retesting 689 to 690, and again, this is where I place my trade on the day, using this 690 call wall as well as a gap resistance. And you can see this call wall falls directly in line with this falling gap, and as soon as we rejected this gap, it just further shows how strong of a resistance level this is. So in our SPY example, the 690 call wall can act like a ceiling, and traders watch it closely because it often signals a resistance level where the market could reverse, even though hedging initially is causing the price to move upwards. So it's a bit of a trap for the bulls and for the bears, and you have to know how to play it accordingly. So what does this mean for traders and investors? Short-term price moves. By tracking call and put walls, you can anticipate where SPY might stall or bounce. The 690 call wall is a perfect example of SPY struggling to break through near the days of expiration. We also have volatility spikes. Option walls amplify price moves around big news or economic events. Even small shifts in SPY can trigger hedging flows that move the price more than the actual news itself. And you have to know risk management. Knowing where call and put walls exist in the market help traders avoid being caught on the wrong side or missing out on unexpected volatility. So essentially, options are not just derivatives, they can actively shift the market through market makers and hedging mechanics. So to summarize, SPY doesn't just move because of fundamentals or news. Hedging and walls can influence price behavior in the short term. And understanding these dynamics will give you an edge to be able to anticipate support or resistance and prepare for volatility, making smarter trading decisions. So it's not something to completely base your trade off of, but it is something important to look at when you're in such a volatile state or on a large ETF like the S&P 500. It's very easy to find the open interest for calls and puts and find outliers on where the market might react more. And this is just another tip to help you in your trading journey. So if you want to learn more in depth in the markets and not just be shown but educated, make sure to like and subscribe. Feel free to ask some questions down below and continue to make smart money with Mitchell Markets.